This is Commodity Wrap on Tony St. James. We're joined today by Brian Hoops. Brian is president of Midwest Market Solutions. At the end of our session on Wednesday, corn market higher, soybeans higher, soy meal higher, the soy oil complex in mixed territory, wheat with a reversal moving higher across the board, all three exchanges, but cotton back in the red. And I'm looking for some optimism here to continue. The rice market broke a two-day losing streak, and the oats market 7 straight sessions higher. Now that we've got that out of the way, let's bring in Brian Hoops. And Brian, let's start with that corn market. Thoughts there?
Yeah, good to see corn bouncing, second consecutive day that we've closed higher. Now the bad news is we closed just a quarter cent or so higher yesterday in the July contract. Same thing today, just fractional mixed type grains. I haven't seen the settlement yet, so we may not even settle higher. It's so close. But at least December is showing some life. Now, you break down this corn market between old and new crop, there's a real discrepancy here. Old crop corn for July trading almost a nickel below December at this time. And that's pretty unusual to see that. And part of the reason is we have this huge crop coming out of South America. The Safrinha corn crop could be 120 million metric tons. It's going to be a big one, and it's really weakened the basis in South America. Brazil's basis has fallen over 40% in just the last 30 days because of this big crop that's going to be harvested. So it's weakening their basis. It's spilling over to the U.S., and our basis is kind of a mess in a lot of areas, especially in the Western Corn Belt. Exports has been decent, but probably will start to tail off because Mexico and Japan, of course China, all could start buying some corn from Brazil because of this newly harvested crop and kind of start slowing down the corn exports. So I think that's really weighing on the July contract and probably will keep it under some pressure until we get into deliveries at the end of the month. Whereas December, we're bouncing from a technical standpoint off of that potential double bottom 434 support area and seeing the technical bounce, which I think will end up being sold eventually, but maybe we can carve out a little bit of a retracement. So producers who haven't done much marketing should be able to have a chance to buy some puts, do some marketing on that rally.
Well, I'm glad you mentioned you brought Brazil into this. Their real has appreciated this year. It's up 9.6%. You brought in Mexico. The peso there is up 8.3%. Let's throw in Argentina. Their peso is actually down 13%. And then you get over to our U.S. dollar. It's lost 8.6% of its value here in 2025. Does that provide at least an opportunity for the U.S. to maybe earn a few more export sales?
It certainly helps, especially the dollar being much, much cheaper, below $100 or 100 points. It really helps us out. And we've seen strong exports for wheat to start this new marketing year. We've seen very strong exports for corn for the 24-25 marketing season. We're just getting to the point where now we're starting to run into competition from Brazil because of their big crop that I think is going to slow down our corn exports, and we're going to may not grind to a halt, but we're going to certainly slow down off of the strong pace that we have been on.
Now, we also have to keep in mind things like ethanol demand here in the U.S. We've got the feed industry, then we've got ethanol, and that's also tied back over to, I guess, soy oil, 45Z, renewable fuel standards, small refinery exemptions, RINs. I'm throwing all the acronyms I can find, Brian. Are all these things tied together?
A lot of acronyms there. Yes, they're all intertwined. And where would we be without demand for ethanol? We're producing record amounts of ethanol. It's the highest in 11 weeks. It was announced this morning on the EIA report. And stocks rose along with it, but we are producing a lot of product. And could you imagine where we would be without all those billions of bushels that are used for ethanol production in the United States? We certainly have massive carryovers Yeah, it's a huge component. It's much more, we use a lot more ethanol for demand than what we do feed usage or for exports. It's our number one source of usage of the corn here in this country. So they're all tied together. Demand has been improving, and as a country, start to move away from the EVs, our demand for ethanol and ethanol-based products certainly, I think, will continue to move higher. Here where we're located, E15 is a very popular gas, and that has a small blend of ethanol in it, higher octane than what a lot of people normally buy at the pump, higher octane plus lower prices, and has at least 15% ethanol. So it's a win-win for everyone to use that and to promote that year-round. A lot of cars are not set up to do E85, but all cars are able to use the E15. So hopefully that is another component that continues to improve as far as U.S. consumer demand as they become more knowledgeable about what E15 is.
Well, let's just say this. We're going to take a break. We'll BRB, and our ETA is just around the corner. We're talking with Brian Hoops, and we've got a whole bag full of acronyms here for you. We'll come back and talk livestock futures. Commodity Wrap continues after this.
That was good, Tony.
Oh, was it?
That was well done. Very well done.
Well, we lucked out, didn't we? Okay, here we go. 3, 2, 1. This is Commodity Wrap. I'm Tony St. James, second segment. And he's so good, we brought him back for an encore here. Standing room only for Brian Hoops, President, Midwest Market Solutions. Kind of worked our way through the row crops in that first segment. Let's focus on livestock here. Live cattle higher, feeder cattle higher, hogs higher. We're talking about markets that have performed really well. If I were sitting down and looking at the livestock sector like you might consider stocks or an ETF or something like that, pretty good returns here, 11.4 coming into the session for live cattle. The return 14.5 for feeders and over 23% for hogs. So it's just showing us the market's been pretty good for these three sectors. What are your thoughts?
The most surprising of the sector, I think, might be the hog market, because we continue to see this hog market push higher. In fact, new highs again this afternoon for August hog futures, and this comes despite the real trade war that we have going on with China. They're our number one buyer, number one customer. I thought they maybe would have slowed down a lot of their purchases, but they've continued to be buyers from the U.S., and maybe they just can't find another protein source as good as the U.S. products, and so they continue to buy this as a food for their people in their country. But that's going to be key, I think, is working out a trade agreement with China or other countries in addition to China to make sure that we are able to sell our pork products. Now, you look at the deferred contracts for hogs, it's similar to cattle. There's a huge discount as the market's trying to build in that we're going to have more supplies available in that third and fourth quarters when demand slows. Well, in the case of cattle, those deferred contracts are at record discounts to the current cash markets, and we are not rebuilding this herd inventory anytime soon. It's going to take several years for us to build that inventory, and these inventories are not coming up. So it makes those deferred contracts, I think, very unattractive as selling opportunities.
Okay. I just can't let us go without throwing in this energy market as well. We've been higher for 2 straight sessions for crude, for RBOB or gas, and 2 sessions higher for nat gas, and a lower trade on Wednesday. Is this just part of the ebb and flow, if you will, of energy markets, or is there something deeper working into this?
I think it's a lot of just normal trade patterns for these energies. Crude oil, the July contract, we watch those futures very closely. We've knocked on the door of $64 3 straight sessions and have been able to get above it, even to trade above it. Now, that's been a resistance point going all the way back to April for this chart. And we're 2 months into it since trading above that 64 area. I think if you could get above 64, close above it, you might have a chance to push a little bit higher going into the summer months. Demand is usually a stronger component during the summer than what it is in the fall, winter, or spring months, as consumers drive a little bit more and more gas is being used. But yet we are well supplied in the world markets. We have a lot of supply, and it does look like Russia and other OPEC plus nations, including Saudi Arabia, maybe Iraq, Iran, want to keep these production levels pushing high, that's how they generate their money, and that's how Russia is funding its wars, by selling a lot of crude oil into the world market.
All right, Brian, if we want to keep up with you, where do we find you?
Well, you can reach me directly. My number is 417-501-5132. You can go online at MidwestMarketSolutions.com, find a list of our offices around the Midwest, and one might be in your back door, ready to help you out.
All right. Brian Hoops, he's President, Midwest Market Solutions, and this is Commodity Wrap.